right, welcome back. And of course, it is half year and it is time for companies to announce their results. Now, CIC Group has reported a profit before tax of 12 billion shillings for the half period ending June 30th, 2023. Overall insurance grew by 20% compared to the state period last year. Now, with all the Kenya and that is within Kenya and all regional subsidiaries recording growth in insurance revenue. Now, the group insurance revenue contributed by Kenya subsidiary recorded a 21% growth. I spoke to CIC Managing Director in charge of life insurance, that is Meshak Miogo, on the role of the sector in increasing liquidity in the capital market, and here is that conversation. All right, so Meshak, thank you so much for making time to speak to us. So we just want you to take us through some of the life products that you currently have in the market, and also just talk us through your current market share, particularly as far as life products go.
The first one is group life. Basically, this looks at things like employee group life, where we have employee benefit solutions. Next time we'll get into details. We have credit life. Basically, if you take a loan from any bank, that loan is normally insured. So that's part of group life as well. So that's one of the solutions we offer. We have groups that come to take group funeral covers. That falls under group life. So that's one of the solutions. The other solution we have is education, or what we call individual life policies, which include education covers, investment, and individual last expense solutions. That is the second bouquet of solutions we have. The last one, of course, as a life company, we also do pensions and annuities. In terms of market share overall, we are position 4 currently, with a market share of 9% according to IRA report of Q1 2023. We moved our market share from position 6 to position 4 within the last 2 years. So that tells you we are also growing, and our growth area, of course, has been the group life solutions. We've also been growing aggressively on pension solutions, and now we are also on a very strong journey in terms of improving our distribution to increase penetration, especially on the individual life solutions.
So on the question of insurance premiums for different life policies, we just want you to take us through the metrics that you currently use at CIC, just to be able to understand how you calculate some of these premiums that your customers end up paying.
Well, when you take any life policy, there are various factors that determine the premiums you'll pay. And the first one is the level of cover that you take, the protection. We normally call it sum assured. It's a basic term that we really encourage customers to really understand that. It actually forms the basis of your life cover, sum assured. And I like giving this simple example, like using a car, so that people really understand what sum assured is. You have a Range Rover worth 10 million. If you go for insurance, you will pay, let's say 4% of that is 400,000. You have a premium worth 1 million. If you go for insurance, 4% of that is what? 40,000. That is the sum assured. Same case to life insurance. The higher the sum assured, the higher the premiums. The lower the sum assured, the less the premiums. The age factor also is critical in determining the premium a customer pays for a life policy. The younger you are, the more affordable it is compared to when you are old. Of course, we look at 18 years to 65 years. So that tells you why some premiums are higher for guys who are older. Same case for medical insurance. If you are 18 and you are 65, you'll pay a different set of premiums. So that explains that. The other thing is we look at the duration of the cover. If you take a life policy which is like 15 years, and I take a policy which is 10 years, for example, even looking at the same sum assured of 1 million, the person taking a sum assured of 1 million for 15 years will pay less in terms of premiums compared to one who takes sum assured of 1 million for 10 years. For example, 10 years you might pay 12,000 per month, and the person taking for 15 years will pay 10K per month. So the period of cover also is very critical. Lastly, premiums are also affected by what we find in the proposal form. There are some things you declare, your health. There are some, for example, if you take a policy of more than 5 million, normally we send our clients for medical, just to do medicals, and then we place cover. When we do that, there are some things we see in the medicals we receive that can prompt us to add more cost to your insurance product. Basically, loading of more premiums. most of the time we don't decline cover. Most of the time we load. So we match your risk to what we are carrying.
We know that the insurance sector particularly has access to a huge pool of resources. So maybe you can help us understand how we can harness this sector in order to be able to improve liquidity within the financial markets.
Okay. So we play a very critical role for example, even let me use an example of life insurance companies. When we receive premiums from customers, one of the duties we have is to invest that particular money, because it is futuristic. You bring your premium here, you are saving for the next 10 years. We have a duty to make sure we invest those particular monies in assets that are going to meet those obligations when they come due. So in the overall economy, we do put money, for example, in bonds. We buy long-term bonds, we buy treasury bills. That way we also participate. And you'll see insurance companies participating in quite a number of infrastructure bonds and all that, basically to match the risks. Even pension, when we receive pension funds from customers, we also have some assets we spend in terms of investing. So that way, that's how we participate in the economy. When we do that, then definitely we circulate the same monies. We also do investments with the local banks and international banks, the ones that are here locally operating, fixed deposits, call deposits for short-term solutions, because claims also come on a daily basis. So that's how we participate in the economy, and the insurance companies play a critical role. Lastly, it is tax. We pay tax, and the taxman is always looking for money. So we do pay tax as insurance companies to KRA. We also pay a number of fees to the regulator. We also do policyholders compensation fund. These are some of parastatals that really work with us to take care of the insureds in case of anything. So basically, it's an ecosystem that supports the economy at a wider scale.
What are some of the criteria that you use to determine which asset classes that you're going to invest in?
So we have investment policies in place, and also we are also guided by the regulator on where to put our money. So one of the classes that we really invest in is, of course, the money market funds as one of the investment classes where we put money. This is basically ensures that we are able to access the money for any short-term obligations. We put money in banks on call deposits. That also is an avenue. We also invest in bonds, long-term bonds. So, for example, if today you buy an annuity with the CIC Life, would put that money into a bond for the long term. And of course, we have to look for a bond that would be able to give us a return that meets the return that also the customer has put their hopes in. So basically, those are some of the ways we really try to really put our investments up.
So the big conversation, not just in Kenya but globally, is the issues around ESG, and particularly on the impact aspect of what companies are doing and the impact that some of this investment they have. So take us through some of the impact of these life insurance policies that you have been able to see within the Kenyan market.
Well, for example, if you take an education policy, number one, you've guaranteed your child an education. And you know very well, an educated child is a beam of hope in so many families and society. And education is a pillar of economic empowerment in any nation. So as insurance companies, giving an opportunity for parents to invest in education, we really drive that bit of ensuring that we sustain livelihoods across. At the same time, remember, maybe your child gets a scholarship and you've been investing in an education policy. So when you receive the partial payments, the final maturity, it doesn't mean that that money goes into waste. That money still circulates back into the economy. You can still be able to purchase probably a house. You can actually invest in other classes. Yeah, so it can become part of your cash flow. It can form part of your retirement, which also ensures that people retire peacefully. So that's a way to look at it. Remember, we not only have education policies, we have products like investment solutions that have an investment component and a life insurance component. So it's also a passive way to save. Sometimes you might not have the time to put an investment where you are able to watch and look at it. Insurance gives you an option to continue driving your business, to continue making a living, but at the same time invest passively and get a return at the end of the day. The good thing, most of the life policies in Kenya, they have what we call a final maturity, where you receive a lump sum. That lump sum, you can take it back to the economy, buy a house, buy land, maybe finish up your building and all that. So that's basically how we permeate through the economy to ensure we support.
All right, now moving on. In an effort to diversify and improve the dietary